keep your mics off during the class. Okay? Because in last class there was an interruption by a student. Okay. Now I am presenting the book to you guys, and we will start this subject. This subject is gonna be your practical subject. You will find practical questions in this subject. Basically, it is related to accounting. So practical subjects are the need of accounting is the base of accounting. Now, wait a minute. One second. Okay, let's start. This is our first unit of Globe First, and its title is Nature and Scope of Accounting. So, anyone know about accounting here? Anyone knows about accounting here? Okay, I guess no. Then let me tell you what accounting is. Basically, what our business is about. Our business is about purchasing and selling of goods. Okay, making transactions like buying goods, buying raw materials, selling the finished goods to the customers, and buying plant and machinery so that we can create goods in them. So that's all the transaction a business person do for his business. So to keep that transaction, to keep that how our business is doing, to know that we do accounting. Basically, we record each and every transaction which is related to accounting, which have a monetary value. We record every transaction which have a monetary value and is related to our business. Then that is known as accounting. It is as simple as that. So, in accounting, what we do? First of all, we identify. If you see this line, accounting is a process of identifying, measuring, recording, classifying, summarizing, analyzing, interpreting, and communicating the financial transactions and events in monetary terms. Every data in our firm which have a monetary value, we will record that in our accounting. uh, First example is like we purchased raw material of 5,000 bucks, so we record it as purchases account debit to cash account. This is a journal entry which I told you about, which I just told you about. Purchases account debit to cash account. So these kind of entries we do in accounting, and only the transaction which have monetary value we record in accounting. No emotional and other kind of transactions or any kind of event happening in our business, we don't record that. Suppose we have two employees, one is performing very well and one is not performing, then we won't record that in it into our accounts book of accounts, because this thing doesn't have any monetary value. So monetary value is a key concept here. I guess it's pretty much clear. And according to AAA, which is American Accounting Association, accounting as the process of identifying, measuring, and communicating economic information to permit informed judgments and decision by users of the information. This is the definition given by American Accounting Association of accounting. So, Yes. Now, as we discussed the definition of accounting, now we need to know about the need and scope of accounting. So, why do we need accounting? Why do we need accounting? Anyone want to guess? You guys can turn on your mics to give answers, and
Oh,
after giving answers, just turn off your mic.
all right,
That's
ma'am.
what I'm trying to do.
All right. Let me attempt. Uh,
Okay,
it is in order to ascertain our profit or loss at the end of our business.
very good. This is the base of accounting because we want to know about if our business is doing good or not. I just said, please keep your mic off. Whose mic is on? Please turn off your mic after answering it, the question. Abdul Ibrahim, please turn off your mic. Thank you. So, you are pretty much right because to ascertain the profit and loss of our business, we do accounting. Without accounting, we can't know that we are making profits or how much profit, or we are drowned in loss, or in how much loss. So, this was the need and objective of accounting. They are similar somehow. So, to keep a systematic record, we do accounting. Like, I purchased the raw material a month ago, and today I am selling the finished goods. So, to keep the systematic record, we can't remember everything, or it's not like that. I am doing the transaction of that 1 month prior buying today. It's not like that. You do a transaction at a particular time or particular day, you record it at the time, you record that transaction on that particular day. So to keep a systematic record, chronological record basically, to ascertain the net effect of business operation like profit or loss, which we just discussed, just to ascertain the financial position of our business, like suppose we are in textile business, we are making clothes. So we have our competitors too, our rivals too. So we should know about the position where we stand in the market of clothes. So to ascertain our financial position in market, we do accounting. To provide accounting information to the interested parties, just like our investors, our public, our government, our manager. So these person are interested in our accounts. These person are interested in our accounts because our investors are invested in us. Okay, invested in our business. So we want to provide them profit, and for that we need accounts, and we need to maintain accounts so that we can show them to them, we can provide a particular report to them. Now moving to the next point, definition we just doing. So identifying, as we discussed earlier, that accounting is the art of recording, classifying and summarizing of a data. Now we will discuss it about this identified. So the first step of accounting is identification. What is it? Identification. Basically, the source. It is a source of document verification, like bill, voucher. If it has a monetary value or not. If this transaction have a monetary value or not, or if this transaction actually happened or not. Because if it have happened, then we have voucher. We should have vouchers or receipts or cash memo of that transaction. So first step is identify that transaction, then measure, then we will be measuring that transaction, like measuring the amount of that transaction. If you purchase 20 if you purchase 10 books of 20 each, then you have to measure its. Am I audible?
Yes, you are.
Yes, you're audible.
Yes. Sorry for the interruption, guys. I just lost the connection. Okay, now I'm good. So where I was, like, here. Then we purchased 10 books for 20 rupees each. Now we have to measure the particular amount, the total amount of that transaction, like 10 into 20, which will be 200 bucks. So the measurement part is there. The next part is to record that transaction. Now we will record this transaction in the form of journal or subsidiary books. Now, after recording the transactions, many transactions of business, we classify them. Like in purchasing the books, we have two items. Like we purchase account or cash account. We have received something and we have gave something. Like we have received the books, but we gave the money, we gave the cash or the bank. So we have two things. So we can classify this transaction into two parts. Like one transaction, one effect of this transaction can go in purchases account, and the second effect of this transaction will go in cash account if we paid in cash. So this is the part of classification. Basically, it means the grouping of transaction of same nature. Like sometimes we have cash transaction, sometimes we have credit transaction, sometimes we purchase goods on credit. So we classify them into this. Then we summarize it. How we summarize these accounts after classifying it, we make at the end of financial year we make final accounts, which is trial balance, profit and losses, and balance sheet of a company or an organization. So these all the accounts are summarizing, and at last we analyze and interpret. We interpret at last that have we made profit or we are at a loss. So this is called as interpretation of that data. And the next step is communication. Then we communicate or tell the progress or the report to the concerned authorities like investors, the CEO, board of directors, managers of the company, and the outsiders are government, public, and etc. Now coming to the point, bookkeeping and accountancy. See, bookkeeping is a narrow term. They you have heard of them as like they are same, but there is a slight difference in both of them. Like bookkeeping is a narrow term. You can say that bookkeeping is a part of accountancy, as it is a narrow term. It only covers the recording part of a transaction, only the recording part of a transaction, just like identifying, measuring, recording, and then classifying. So it doesn't require any high level of learning about accounting. We just record the transaction. Anyone can do record the transaction. But in accountancy, you start making accounts like ledgers. You transfer the journals into ledgers. Then you prepare final accounts, which is profit and loss account and balance sheet. So accountancy has a broader term than bookkeeping, and or you can say that bookkeeping is a part of accountancy. All the things like summarizing, analyzing, interpreting, and communicating is the part of accountancy. Okay. Now, next point. Users of financial accounting information. Why are we making these accounts? Who are going to use this? Okay, now we will know about the users of financial accounting. to understand the present position of the enterprises, to compare its present performance with that of its past year. Just like sometimes we want to know where our company stands in the market. To understand our current position in the market of our enterprise, we have to make accounts. We have to prepare our accounts, our books of account for our business. Now, to compare the present performance with that of its past, it is also known as intra-firm comparison. As I told you in another subject, the word intra or inter, it is also mentioned here. Like this transaction, this point is known as intra-firm comparison. Like when we compare our company this year with the last year, like how much profit we made last year, like 2022, and how much profit we made in 2023. This comparison is known as intra-firm comparison. And when we compare our profit and losses or the position of our firm with other company, like when we compare Samsung and Apple phones. Okay, when we compare the books of account of Samsung phones and Apple phones, then that is known as intra comparison. And when Samsung compare its progress or its account from this year to previous year, then it is known as intra-firm comparison. But when we compare two different organization of a similar enterprise, then it is known as inter-firm comparison. Is it understood? Is it understood?
Yes, it's understood.
Okay. Moving next. Accept this. What is the use of financial accounting? Owner wants to know about the position of his company. Okay. Manager wants to know so they can plan or control the business operation. Okay, so they can if be you being the manager of a business, so you need to have the final accounts of your business so that you can plan accordingly how you can improve the profits of your company. Okay. Lenders, these are the investors. Maybe some of the business took loan from others, so lender want to know the lenders are interested in your financial account, in your company's financial account, because from this they get to know that can you repay their debts or not, can you repay their money or not. So it is necessary for them to look into your accounts. Creditors. Creditors are those who supply goods and services on credit to us. Okay, it's common in business. Like we purchase raw material on credit. We always don't have cash to purchase the raw material. So we purchase the material on credit. So those person who are giving us the raw material on credit are known as creditors. But now when we have to pay, we have to repay them. Okay, we have to pay them. So they want to know about our financial positions so that they can decide can we pay back to them or not. Okay, it is important for them also. Prospective investors, a person who wants to become a partner, like you are you are you are opening your company as a public company. Okay, now the public wants to know about your company, your profits, your losses for the past 5 years or 3 years. They want they want to know about the final accounts of your company. So the prospective investors, after reading the final accounts, they can decide whether to invest in your company or not. Tax authorities, tax authorities like government also interested in your financial accounts so that they can assess the tax liability. They can ask for money for the tax money. Employees, why do employees need? So that they can ask for bonuses, They can think that they are safe in the company are not going bankrupt. They need to know about this. Now, the owner, manager, and employees. I'm repeating, the owners, manager, and employees are the internal users. Like they are related to the company. Owners, manager, and employees. They are involved in the company. They are internal users of final accounts. But the lenders, creditors, prospective investors, and tax authorities are known as external users. Okay, moving to the next point, accounting as an information system. Accounting is the language of business. This is how a business talk. The main objective of accounting is to provide information to its users. Now, accounting is also divided into financial accounting and managerial accounting. Accounting is also further divided into financial and managerial accounting, whereas financial accounting refers to the preparation of general purpose reports for use by the person outside an organization. Okay, like like government, lenders, investors, all these are the outsiders or external users. If we talk about the managerial accounting, so managerial accounting refers to providing the information to managers or the person who are inside the organization. Basically, we can say that all the internal users are for all the internal users there is managerial accounting, and for all the external user there is financial accounting. Wait. Now, it is also mentioned, you can also look at this diagram, that accounting have two parts: financial accounting and managerial accounting. Financial accounting is for creditors, its shareholders, tax authorities, or other external users. And management accounting is for managerial decision making, like managers, employees, and etc. Now, uses of accounting information. How can we use the accounting information? Managerial decision making. Okay, managers need to plan for the coming year how we run our business now, how much production we have to make. So all these decisions are based on the final accounts. Managerial planning, control, and internal performance. For example, if we made loss in this year, then analyze where our business went wrong, and how can we solve the issue. That's what point is telling us about. That's what this point is telling us about. External financial reporting. In this, we supply the information to the third party who are interested in our firm. I just say like shareholders. They are always interested in our firm and in our final accounts. Because from these final accounts, they analyze if they want to keep their shares, their share of amount in our company, or they want to sell their share of amount. Branches of accounting. We have three branches of accounting: financial accounting, cost accounting, and management accounting. Financial accounting, cost accounting, and management accounting. This part of accounting, which is financial accounting, it is based on like final accounts. It prepare final accounts like trial balance. It gives you, or to ascertain the profit and loss of a company, we prepare financial account. profit and loss account, balance sheet, trial balance, ledgers. All these accounts are related to financial account. Cost accounting. So cost accounting is done to ascertain the cost of each product or operation or service which our business is providing. To ascertain the cost, to manage the cost, like it generate the to manage the cost or to reduce the cost. Like the cost of the goods are so high, so cost accounting will tell you about how we can reduce the cost, or is it making any effect in the cost or not. Economics is all about the cost accounting. Now our this financial accounting is all about the financial accounting. Now coming to the point, management accounting. It generates the type of information which help in future planning decision making, like how we have to perform in future, what should be our plan to accomplish our goals. Okay, what goals we should set for our next year. All these kind of decisions are taken here or managed by this accounting. Advantage of accounting. So replaces memory. Like we are humans, we can't remember everything we do or every transaction happens in our business daily. So to replace the memory, we do accounting or we record every transaction on the time. It provide control our assets, like cash in hands. We get to know about how much cash do we have at cash in hand or cash at bank, how much stocks do we have. Okay, now facilitates the preparation of financial statement. Accounting only facilitates the preparation of financial statement or final accounts. Like if we don't record any transaction, then how can we prepare profit and loss account and balance sheet out of it? So accounting is only helping us to prepare final accounts or financial statement. Meets the information requirement. It helps us to tell about business position to others. Business position to others, to outsiders or inside users. It facilitates a comparative study. As we discussed earlier, we can compare our position, financial position, with our last year financial position or with other companies. Assist the management in many ways. The identification of reason help in taking necessary steps to increase the profit further or to avoid losses. Difficult to conceal fraud or theft. Like we can do audit to detect any kind of fraud. If our manager or if our accountant do any kind of fraud, then we can audit it. Okay. For tax matters and ascertaining the value of business. Now, limitations. Like the first limitation is no record of non-monetary transaction. We do not record any kind of transaction which doesn't have monetary value. Like emotions, values of the person are not required or not catered in accounting. There is no place for emotions in accounting. The data is historical in nature. Like suppose I purchased a building of 20 lakh in 2015, but now its market value is increased to 60 lakh. But in our books of accounts, we have to maintain its cost as 20 lakh only. Like whatever we whatever amount we have purchased a good or we have purchased a asset, we have to mention that amount only. We don't keep on changing the amount of the assets. So they do not reflect the current value of our assets and business. They do not reveal the true picture. Like estimates may be used to determine the value of various items. Suppose I have purchased a machinery of 50,000, a machinery of 50,000 in 2015, and I have put a depreciation of 10% every year, okay, on machinery. So after 2015, in 2016 its value decreased to 40,000 after reducing 10% depreciation of on 50,000. Its value will be 40,000 in 2016, and in 2017 its value will be 30% for 10% of 40,000, which is, sorry, not 10% of 40,000. I'm reducing the value, uh, 10,000 every year. Okay, I'm reducing the value 10,000 every year of this machinery. So 50,000 in 2015, 40,000 in 2016, 30,000 in 2017, 20,000 in 2018, 10,000 in 2019, and zero value in 2020. But the machinery is still working, still producing goods for our business. And it is not reliable. It is not reliable. Or estimates may be used to determine the value of various items, but they are not. They do not reveal the true picture. They do not reveal the true picture of the data. So these were the limitations of financial accounting. Are this clear? Is this clear? I know we are a bit fast today.
Yes, we are a bit
Am
fast,
I?
but we're trying to follow where we can.
Okay. Moving to the next point, basis of accounting. Cash basis or accrual basis of accounting. See, we have two types of accounting, two bases of accounting. Like some people do accounting like on cash basis. They only record the transaction which involves cash. They only record the transaction which involve cash in it. Like you have purchased goods of 5,000 bucks for cash, then you will record the entry in your books of accounts. But if you have purchased the goods for 5,000 bucks on credit, then you won't record that entry. That is what cash basis of accounting means. You only record the cash transactions. Okay. In accrual basis of accounting, you record every transaction. You record every transaction of or credit, either it is credit or at cash, or it is a prepaid rent, or it is an outstanding salary. Everything you record in accrual basis of accounting. I guess it is clear. Now, qualitative characteristics of accounting information. Qualitative characteristics of accounting information. See, it should be understandable. Accounting information must be understandable. It must be, it must be sold easily, or it must be presented easily, in pie chart forms, in table forms. Okay, it must be presented to the outsider or insider users accordingly, or in easy language. Usefulness. Business owner needs accounting information that is applicable to the business decisions at hand. Okay, it must be useful. The data you are showing must be useful to the owner or the user. Relevance. See, only relevant information must be provided to the users. Only relevant information, like salary slip of employees is not relevant to the investors, as they need only P&L and balance sheet accounts of a company. What they will do of salary slip? You don't need to show the salary and etc things. To your investors, they are just interested in your profit and loss account or balance sheet. Reliability. It must be accurate. You are not making up the transactions or do any fraud with the data. So your transaction must be real or must be accurate. No omission, no omit, no mistakes should be in your accounts. Comparable. Your data must be comparable. It should be comparable to your competitors, to your own. Consistent. Inventory purchases should be recorded the same way as yesterday, today, and tomorrow. Suppose uh, you have started or your company have opted depreciation as an SLM method. Depreciation is a SLM method. So you have to complete this depreciation with SLM method for a longer time period. It's not like today you are using the SLM method for calculating the depreciation, and in next year you are applying the direct method of depreciation calculation. No, it should not be like that. So consistency is the key here. Functions of accounting. It is same as we discussed earlier. First we record a transaction, then we classify it. In recording we have journals. What are journals? Basically in journal we record every transaction in raw. Okay, as it is. And we have some s- books also, like subsidiary books, we call them subsidiary books of accounting, and we directly record the transaction in subsidiary books. In If you are running a big organization or a big business, then we record the transaction in our subsidiary books. What subsidiary books are like cash book, sales books, purchase books. Okay, these kinds of book we record. It is easy to classify from these books. Okay, then journal. Classifying. The next step is classifying. When we record our transaction in journal, the next step we do is classify them. Like we did a sale. We did sale of goods for $5,000. We did sale of goods for $5,000. What we will do now? The entry will be cash account debit to sales account. We have two accounts involved in this. First is cash account, second is sales account. Because we received cash, but we let go the stock, we let go the goods. So sales account and cash account. In ledger, we transfer this entry in two ledgers. First is sales account and second is cash account. That is known as classifying. Summarizing. Summarizing is as at the end of classifying, we prepare trial balances at the end of a year, financial year. We prepare trial balance, income statement, balance sheet to ascertain the profit and loss of the company. The last step is analyze and interpret. After preparing balance sheet and all, we finally can interpret our transaction, like if we made profit or how much profit. Then communicate. Then we will provide the information to others or to the users of final accounts, financial statement. So that's all about this unit. Is this unit clear?
Clear.
Yes,
Okay,
it's clear.
okay. We are moving to the next unit. Accounting process and rules. Please turn off your mic. Haider, please turn off your mic. Thank you. Accounting process. We just discussed it, yeah. Recording, classifying, summarizing, and interpreting. It's just one thing coming again and again. So, I'm telling you about the accounting cycle. First, a transaction happened. First, a transaction took place. Then, we record it in our journals. Then, we record it in our journals. Then, we transfer it in ledger. Then, we transfer it in ledgers. From ledgers, we create trial balance. From ledgers, we create trial balance. And the next step is to create trading and profit and loss account. Trading and profit and loss account. In this account, we can tell that our company have made profit or not in this account. And the last step is balance sheet. And the last step is balance sheet. In this, we balance like the assets and the liabilities of the firm. So, what is an account? What is an account? Basically, account is a T-shaped, vertically divided. Account is of T-shaped, vertically divided concept. Account is a summarized record of the effect of all transaction. Account is a summarized record of the effect of all transaction. You are seeing that account here. That's a diagram of an account. This is the head of this account. The left side. The left side is considered as side of any account, and the right side is considered as the credit side of any account. Debit is the abbreviation. DR is the abbreviation of debit, and CR is the abbreviation for credit here. Classification of accounts. Generally we have three types of accounts. Generally we have three types of accounts: personal account, real account, and nominal account. This topic is very crucial. Please focus on this topic. First is personal account. As the name say, this accounts relates with the person. This accounts relate with a person, like Josh account, like owner's account, like your own account. Okay, this relates to the person. And and along with the person's account, the capital and drawing account. Do you know what a capital is? Do you know about capital and drawing, or I have to elaborate this too? Let me know.
Sorry, can you come again?
I know capital.
Okay, and drawings?
Drawings now.
Okay, I'm explaining both of them then. Okay, capital. Capital is something which a owner, okay, which a owner invest in his business. Whatever amount a owner invests in his business is known as capital. Okay, now coming to the point, drawings. Whatever amount a owner withdraws out of business for his personal use, remember, for his personal use, then it is known as withdrawings. Suppose you have withdrawn 2000 bucks from your business. You have withdrawn 2000 bucks from your business to purchase raw material. Then that is not considered as a drawing. That will be not considered as a drawing. But if you withdrawn 2000 rupees for your personal use to purchase something, okay, to purchase clothes or whatever you need, then that is known as drawings. So, capital and drawing account is also a personal account because it is directly related to the owner. Always remember, capital and drawing account is directly related to the owner, so they considered as a personal account. They will be treated as personal account. Okay. Along with personal capital and drawings account, we have some more accounts to personal account, like expense payable, expense paid in advance. Like we haven't received the material, but like I have paid rent in advance, like I have paid rent of my firm in advance, then it is considered as personal account. Okay, I have received an income, I have received an amount without performing my activity, then it is known as incomes receivable, income received in advance, income received in advance. So these kind of accounts are also known as personal account. They will be considered in personal account only. Coming to the point real account. So real accounts are related to assets. All the assets, like cash is also the asset of a company. Bank, the amount we have in bank is also the asset of a company. Land and building, furniture, machinery, whatever asset we do have for our business, the account we are making for them is considered under real account or will be treated as the principle of real account. Okay, now coming to the point nominal account. All the expenses and income, all the expenses and income are considered under nominal account, are considered under nominal account. Now you may be confused expenses or income with this thing, like income received in advance or income expense paid in advance. There is a difference. There is a difference. See, salary, if you are paying salary, normal salary, then it is considered as a nominal account. If you are paying rent, then it is considered as a nominal account. If you are getting interest, then it is considered as a nominal account. But when you pay salary in advance, hear me out. When you pay salary in advance, then it is considered as personal account. When you get interest in advance, basically you get an income in advance, then it is known as personal account. Okay, if the things expenses are on time, expenses are income on time, then it is known as nominal account. If there is outstanding or advance payment, then it is known as personal account. Is the difference clear between among these three? Is the difference clear among these three?
Yes, the difference is clear.
Okay.
Sorry, madam. I'm a bit behind about the nominals account.
Okay. Nominal account. Let me explain it to you again. Nominal account is related to income and expense account. Nominal account is related to income and expense account. Every income and uh, expense we pay in our company for our company is considered as a nominal account, such as interest. Like we pay interest to our shareholders. Okay, that is considered as nominal account, as interest account. When we pay wages to our laborers, so there will be a wages account and it comes under nominal account. Okay, when we receive interest or any kind of commission, so commission account, interest account, these all things are considered in nominal accounts. All the assets are related to real account, and all the owners thing, like owner's account or anyone else account, if a person name is related to that, then it is known as personal account. Is it clear now?
Yes, clear, madam.
Okay. Now moving further, here is a chart explaining all these accounts. You can see. See, accounts have two type of accounts: personal account and impersonal account. Personal account we discussed, and impersonal account can further be categorized into two parts, which is real account and nominal account. And you can see the accounts here. Now, this okay. Let's do this exercise. Okay. I'm asking. You will tell me. Bank account. Bank account. In which class of account it will come? Anyone?
Personal account.
Personal account. Very good. Interest account. Interest account.
Nominal account.
Mm,
Nominal account. Great. If I ask about loose tools. Loose tools account. Try.
no, no,
Anyone else?
nominal account.
Nominal. No. Sorry, it's a real account. They are tools. Tools are assets for our company. Okay. Either it is loose tools or other tools. Tools are assets for our company. So assets are related to real account. So it is considered under real account. Okay.
Okay, ma'am.
Okay. Now you won't answer. Somebody else will. Okay. Give exposure to them as well. Tell me about loan from Gopal Das account. Loan from Gopal Das account.
Nominal account.
It is personal account.
Personal account. Yes.
See, it was a tricky one. We have taken loan from Gopal Das.
Yes, very
We have
tricky.
taken loan from Gopal Das, and there is a name. This is a name, Gopal Das account. This is a name of person. So that is it is considered as that is why it is considered as personal account. Okay, understood?
Yeah.
Stationary account. Stationary account.
Personal account.
It's nominal. Personal account is related to persons. Stationary is not a person.
Yeah, yeah. Understood, ma'am.
Okay. Just practice these things, okay?
Since stationery is an expense, it falls under nominal account, right?
Stationary is an under nominal account.
Expense. Isn't this supposed to be an expense?
Because stationary are not our assets. It considered as an expense. Stationary is an expense. You do.
So since it's an expense, it falls under nominal account.
Which one?
Stationery, isn't it an expense? Since it's an expense, isn't it supposed to fall under nominal account?
Nominal account. Yes, stationary is under nominal account because stationary is neither our asset nor our person, nor is a person. Then, how do we consider stationary as a nominal account? It is an expense we made. We spend cash or bank. We spend our money to buy stationery, and it's just you. We just use it like an expense in our business. It's not an asset. It won't go for a long time. You are using a pen, it will end in. If you are using it too much, it will end in 5 or 7 days. So this is what stationery is. Like paper sheets, A4 size sheets for printouts. This is all what stationery is. That is why we are taking it as a nominal account because it is an expense. Electricity charges. Tell me about electricity charges. It's the easy one.
Electricity charges and those expenses as well. Electricity charges, rentals, so and they're supposed to fall under nominal account as well.
Yes, you are pretty much right. It goes under nominal account. Now, moving next, principle of double entry. Principle of double entry. See, we do transaction, we record our transaction with dual effect, with dual effect. Dual effect of each transaction. When we purchase a material or raw material, when we purchase anything, it will give two two effects to you guys. Basically, it's an receiving or giving aspect. It is a receiving and giving aspect. One thing you are giving and another thing you are receiving. I am giving cash for land and building. I am giving cash for machinery. Cash is the giving aspect, and machinery I am receiving out of it against it. So this is what dual effect is. One thing have a giving aspect and another thing have a receiving aspect. When you do sales, when you do sales, then goods you reduce goods from your stock. Okay, you reduce goods and you increase the cash or bank account. So one thing you are receiving and another thing you are giving. It is as simple as that. So every transaction in business have dual effect. Minimum two effects are there. Maximum can be three or four, but minimum two effects are there. So the receiving aspect is debit and the giving aspect is credit. Always remember the receiving aspect is debit. You have seen the account diagram now. So the debit side is all about receiving aspect, and the credit side is all about giving aspect. Debit side is about receiving aspect and credit side is about giving aspect. Now I'm taking an example like you have purchased goods. So you will be debit purchasing account, goods account. You will be debit goods account and you will be crediting cash account because you received goods. So goods account debit and you have given cash against it. So you reduce or credit cash account. Is this point clear? Debit is receiving and credit is giving. Remember this.
I have a question, madam.
Yeah.
So my question is, if I'm owing people money, what am I
Sorry.
called? If I'm owing people money, what am I called?
I'm not understanding. Can you please
In a
write that?
business? All right.
There is a buffering, I guess.
Okay.
Please write it. So a debtor. It's not debitor, it's debtor. It's not debitor, it's debtor. A debtor. Is it clear, Alita? Okay. Now, yeah, but I was where I was at principle of double entry. So principle of double entry is clear, na? One person is you receiving one thing and giving one thing?
Yes, it's clear.
Oh, okay. Now, accounting rules. Accounting rules. We have accounting rules for each account. Like personal account, we have different accounting rule. For real account, we have different accounting rule, and for nominal, we have different accounting rule. So, for personal account, as we know that personal account is related to persons, owner, owner like capital account and drawings account, and other expenses which are outstanding or prepaid, other expenses or income which are outstanding or prepaid. So these for these personal account stand. Now the rule for personal account is debit the receiver, credit the giver. I'm repeating, debit the receiver, credit the giver. Debit the receiver, credit the giver. Like you have purchased, you have purchased goods, you have purchased goods on credit, not on cash. I'm not talking about cash here. You have purchased goods on credit from Ram. Okay, you have purchased goods on credit from Ram. So the entry will be whom you will be debiting. What you have received. I have received goods. So goods will be debited. Debit the receiver. And whom I will credit? The giver. Who have given me the goods? Ram. Ram will be credited. Goods account debit to Ram. Goods account debit to Ram. That will be the entry for credit purchase. So debit the receiver and credit the giver. Real account. So in real account we have the rule debit what comes in, credit what goes out. Debit what comes in, credit what goes out. Like I have purchased a machinery, I have purchased or I have sale. I have done sale for cash. I have done sale for cash. Then what will I do? I will debit the cash. What comes in? What comes in? Cash. Cash comes in my hand. And what goes out of my hand? My stock, my material, my goods goes out of my hands. So cash account debit to goods or purchases account. Cash account debit to goods account. Nominal account. Nominal account. Debit expenses and losses and credit income and gains. Debit expenses and losses and credit income and gains. Like you have paid salary to someone, you have paid salary to your employees. So salary is an expense for you guys. Salary is an expense. So what will you do? Now in this case, salary account debit to cash. Salary account debit to cash. Salary account debit to cash. If you have received any kind of interest or commission, then what will you do? Commission account debit, sorry, cash account debit to commission, because you have received in cash now. It is an income, then it have to be credit. If it is an income or gain, it have to be credit. So what will you do? Cash account debit to commission account, cash account debit to interest account. If you have received rent from one of your property, then it will be cash account debit or bank account debit to rent account. Is it clear? For personal, real and nominal account.
Not clear on the real account, madam. Can you repeat?
Real account.
Yes, madam. Real
Okay.
account.
It is related to assets. It is related to assets like machinery. Real account is related to asset like machinery, land, building, and furniture, and the cash and the bank. These all things are your asset of a company. Now it is this rule says debit what comes in and credit what goes out. Whatever you are getting debited, whatever you are getting debited, and whatever you are losing then credited. Whatever you are losing to credit it. I'm giving the example of purchase. You have made purchases. You have made purchases in cash. Like you have purchased goods in cash, then what you will receive, goods you will receive. Okay, goods you will receive, then the goods account debit, and what you will be giving, the cash or bank, to the cash account. Goods account debit to cash account, you will lose cash, so that's why it's going to be credit. And you are receiving goods, that's why it's going to be debit. Is this clear?
Clear, madam. Clear. Yes, clear.
Moving further.
Excuse me, I have a question. Um,
Yes.
if I say, for example, personal account and real account are similar, how right am I?
No, they're not similar. Personal, see, personal account and real account is not similar, because in personal account you are dealing with persons, like the owner of the company you are dealing with, just making the creditors and all. You are doing credit purchase. See, if you are doing credit purchase, I'm taking the example of purchase. If you are doing credit purchase, then there will be a name of person, there will be a person involved in it, then it goes straight to the personal account. But if you are purchasing your goods in cash, then it straight go with real account. You're understanding my point? So personal and real account is really different from each other.
All right, it's clear. I understood now.
Now coming to the next unit, or before going to the next unit, I would like to do this exercise with you guys. Okay, for better understanding of the things. Now, read the transaction. Commenced business with rupees 50,000 as capital. Now, a person have commenced the business, means the owner. He have invested the capital of 50,000. Which accounts will be affected in this transaction? First, cash account, and second, capital account. First, cash account, and second, capital account. Owner doesn't have its owner doesn't have its separate account. Owner always have a capital account. Capital account is directly related to the owner. Okay, whatever investment is doing is does go straight to the capital account. Whatever drawings he are doing, or whatever withdrawals he is doing, is came out straight from the capital account. So that's what is capital account. It's a owner account. So when we invest or start a business with rupees 50,000, then it will affect two accounts. First, cash account, because we get cash in our business, and there is a capital account. Now I'm telling you something which is important. Always consider your business and owner of the business as a separate entity. Okay, your business is different than your owner. Every business is different than its owner. This capital amount is always the liability for a business, because it's business responsibility or duty to give you fair returns. You are just like an investor for your business, but the issue here is that you are running that business. Sometimes we relate that business and owner is same, but no, business is always considered separate or different with owner. Okay, they two are different things. So that's why when a person invested in a business, then business get cash, and in capital account it is credited. So entry will be cash account debit to capital account, because now or in future, either now or in future, business have to repay this amount to the owner. So it is taken as a liability. Cash account or capital account. So cash account is related to real account, okay, and capital account is related to personal account. Cash account is related to real account as it is a asset for a company, and capital account is related to personal account as it is the owner's account. So cash account debit, capital account credit. Is this entry clear to you guys?
Clear, madam.
Okay. Now this third entry. I bought goods from Soham on credit rupees 10,000. When you bought goods from Soham on credit for rupees 10,000, then you have two accounts in it. First is goods account and second is Soham account. First is goods account and second is Soham account. So goods account is directly related to real account because goods are the asset of a company. Goods are the asset of a company, and Soham account is related to personal account as it is the name of a person. Then it is related to a personal account. Now the entry will be goods account debit to Soham account. This thing we have received, okay, and we are liable to Soham, so we are crediting him. So goods account debit to Soham account. This is the journal entry for this transaction. Now, sold old typewriter. Sold old typewriter of rupees 500. Typewriter is an asset for a company. Now we have sell them. So when we sell it for 500, then it includes cash account and it includes the asset account, which is typewriter. Asset have different type of account, na? Like land and building account different, machinery account different, typewriter account different, furniture account is separate. So all of these are assets and it is related to real account. So both the accounts are the part of real account. The entry will be cash account debit to typewriter account because this is what comes in and this is what goes out. Cash comes in the business and typewriter goes from the business. So these are some transaction for the better understanding of real personal and nominal account. I hope I'm able to m- make a clear point of real nominal and personal account. You understood it?
Yes, ma'am.
Okay. Now moving to the third unit, accounting principles. Some basic terms and accounting principles. Before moving further, we have some basic terms for accountancy, like entity. Entity is a separate legal entity. Like every business have a name, every business have a name, then that is known as entity. Sometimes we purchase land and building or asset in the name of our business, in the name of our business. Like uh, suppose Apple company is purchasing a land in the name of Apple company, then it is not related to a real person. It is not related to a real person, but it is related to an artificial person. The Your business will be act as an artificial person, and you can sign or you can purchase or sale of land and building or assets in the name of your company, then that is known as entity. Every business have a separate legal entity. Business is different from its owner. Okay. Event and transactions. Like transactions is of two type: cash transactions, credit transactions. I don't think so. I need to explain this in brief, in details. Like I already discussed it, what cash transaction is and what transaction is. Coming to the point, goods. See, goods refers to the article in which the business deals. Okay, for a fan dealer, fans are goods. Okay, for a fan dealer, fans are goods. Suppose you are doing business or you are dealing in computers. You are dealing in computers. Then in your shop, or in your firm, you may be having many furniture, you may be having ACs, you may be having desks, you may be having tables for better or smooth running of the business, but that will not be your goods. The goods only will be computers because you are selling them. You are not selling your furniture to earn money. No, no. But you are selling computers. You computers are what you deal in. So these are goods, and the other things which are supporting to your business like furniture, AC, fan, okay, doormat, and the computer you use personally at your business, the computer you use personally at your desk to record every transaction of your business is known as asset for your company or your business. This is the difference between goods and assets. Data. Alicia, this is what you were asking before. A debtor is one who owes some amount to business. A debtor is one who owes some amount to business. Like, suppose you have sold goods on credit to someone. You have sold goods on credit to someone, then that person owes you. Okay, that person owes you, and he or she will repay you after some time. Then that person will be called debtor in your accounts. And who is creditor? It's just opposite of debtor. When you purchase goods on credit, when you purchase goods on credit and you owe some amount to someone, then that person is known as creditor. Books of accounts, like we make books like journal, ledgers, all these things are known as books of accounts. Entry, every transaction we record is known as entry. Journal, journal is where we record each and every transaction as raw as they are in our books. Okay, this is the first step for our accounts. Ledger. After making journal, we transfer our transactions or entry into ledgers. Like, I have made a journal like cash account debit to purchases account, cash account debit to purchases account. But see, whenever I see two in an entry, that means that the account which is related with two is under credit. Okay, it is related to credit. Cash account debit to purchases account, that means cash is debited and the purchases account is credited. Now ledger, when we transfer our entry to the concerned account, then it is known as ledger. Ledger can be a building account, furniture account, capital account, salaries account, cash account, etc. and etc.
Sir, getting some background noise from Abdul.
Sorry, please. I totally forgot my life.
To debit an account and to credit an account. When you do entry on the left side of an account, when you do entry or write an entry on the left side of an account, then it is known as to debit an account. When you do entry or transfer an entry on the right side of an account, then it is known as credit an account. Assets, I guess I cleared it with goods. Expenditure. Expenditure means spending our money in our business so that we can benefit or get returns out of it. Like I am investing or I am spending money to purchase a machinery. But this machine will provide profit or will create or produce goods for me in future. So this is known as expenditure. Whatever thing you spend on, and if that thing will give you returns or fair returns in future, then it will be known as expenditure. Equities is of two types. Like when you claim your rights on your assets or the business, we have two types of equities, like creditors equity or owners equity. As I just cleared that capital which a owner invested in our business is known as a liability. It is also a equity, means capital, an owner have a right on the assets of a business. And creditors equity is if the owner have lent some money, have loaned some money from someone, then it is also known as creditors equity. If someone outside from the business is investing in your company or your business, then that is known as creditors equity. Liability is the amount owned by the business firm to the outsider other than the owner. Liability is the amount owned by the business firm to the outsider other than the owner. Like when you take loan from bank, when you take loan from a particular person, all these things are liability. Creditors is also your liability because you have to pay to them. Capital drawings is clear. Profit is, we won't know, I guess. See, gain. Profit is when you profit is when you have excess of income over the expenditure in your business. But gain when you sell your assets, or when you appreciate in value of when there is an appreciation in the value of land and building, or on your other assets, then that is known as gain. Okay, suppose you have a building for your business of 30 lakh rupees. Now its value increased to 60 lakh rupees. So this 30, the difference of 30 lakh rupees, the difference of 30 lakh rupees is your gain, not a profit. Trade discount and cash discount. Whenever you are doing a transaction or trading something like purchasing or selling, sometimes you get discount or sometimes you give discount, then that is known as trade discount. Okay. But cash discount is, suppose uh, you have purchased furniture for your company on credit. Okay, on credit. Now you have a due date after 5 months, but after just 1 month, you are ready to clear your debts. You are ready to clear the payment. So in that case, sometimes the owner or the person or the creditor of yours are happily give you a discount. That discount will known as cash discount, because it was not at the time of trading, but it was at the time of when you clear your debts. So that is known as cash discount, and that is the difference between trade and cash discount. I guess it is clear. Moving further. Accounting principles. We have some accounting principles which we follow worldwide. Which we follow worldwide. So accounting principles are categorized into two parts. First is recording stage principles and second is reporting stage principle. Recording and reporting. Like business entity concept, monetary measurement concept, objective evidence concept, historical record concept. These all are the concepts of accounting principles. We will read about them one by one. They are easy as they are looking. Okay. Business entity concept. So business entity, we are doing the accounting principle of recording stage now. Okay, business entity concept. What business entity concept tell us about? It says like business, like I said earlier, business and owner of a company is a different thing. We never mix them. We never should mix them. We should always consider we should always consider owner as the creditor of a business. Okay, because now or in future our business have to pay the amount to the owner. Business have to pay that amount which a owner have invested to the owner. So no personal entry of owner is recorded in the books of account. No personal entry of the owner is recorded in the books of account. Suppose, uh, suppose the owner have withdrawn money. The owner have withdrawn money from the capital for its personal use. You will use or you will show that amount as in drawings, but you will not show that where he have spent it. Okay, in which area he have spent it. No, we won't show that. So no personal entry of owner is recorded. If a owner purchased a car for its personal use, we won't show or mention it in our accounts. Money measurement concept. Like only monetary events are recorded. Only monetary events are recorded. No other than monetary value event are be recorded in this accounts or final accounts or in financial statement. Objective evidence concept. Like record a transaction with evidence only. If you don't have evidence of a transaction or someone is saying like uh, we have purchased goods for this amount without any voucher, without any cash memo, without any receipt, then you won't record that entry because evidence is must. So objective evidence concept tells us about do not record a transaction without voucher receipt or cash memo. You have you have also you have to maintain that voucher receipt or any kind of document for the future to audit. Historical record concept. We record only those transactions which have actually taken place and not those which may take place. Okay, like transactions are to be recorded in chronological order. Suppose you get an order to create 50 shirts. You are in a business of textile, you get an order to create 50 shirts. You won't record that immediately until or unless you are completing that order and selling that to that person. You are not recording it. So historical record concepts is just saying that do not record entry prior it happens. Only record what have happened and the entry took place. If the transaction didn't took place, do not do not do record of it. Cost concept. The price paid to be paid in the case of credit transaction at the time of purchase is called cost. Like if the business buys a machine of 80,000, it would be recorded in the books as rupees 80,000. Like in case its market value increases later on 1 lakh or decrease to the rupees 50,000, it will continue to be shown at rupees 80,000, not at its market value. Just like that, just like the example I just told you earlier, um, like we have purchased a land of 30 lakh, huh? And after some time the price got hiked and its cost now is 90 lakhs. But in books of account the cost of that land will be 30 lakhs. We will not change the cost of that land. That what cost concept tells us about. Dual aspect concept, like every entry have two sides or double effect. So we have to perform every we have to transfer every entry with dual aspect, like every receiver is also a giver and every giver is also a receiver. So we have to follow this concept. Like when we are buying something out of cash, then goods account debit. If I am buying goods, then goods account debit to cash. Now we have two things: goods came and cash goes. So I will enter two effects in our books of account. Like in first one is in goods account and second was one is in cash account. Why do we do so? Because we have always have to show in balance sheet that liabilities is equal to assets. Liabilities is equal to assets, and liabilities is also known as equities. And we can further divide liabilities into two parts. Liability is made up of capital plus outside liability. As I said earlier, capital is owner's investment, it is considered as liability. Capital or outside liability. Outside liability is when you took loan from bank, loan from a person, okay, shareholders if you have, then these are considered as outside liabilities. Creditors you have, these are considered as outside liability. Their sum must be equal to the assets. Then only you are liable or you are in good position. They must be equal. If capital or outside liabilities side increases, suppose if capital or outside liability side or liability side increases, then you will go insolvent in your business. You will go insolvent in your business. You will not be able to pay your debts. Okay. Now, reading this illustration, Mr. Gyanchand started business with rupees 50,000 cash. He purchased a set out of this 50,000. Now we have capital. Capital is liability and we have asset. Capital is equal to asset. Capital is 50,000 and assets are 50,000. So his investment is 50,000 and we have machinery or anything he have purchased of this 50,000 is assets. Is this clear?
Yes, it's
Clear.
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 Okay, okay. Moving forward, concepts to be observed at reporting stage. Going concern concept, accounting period concept. Let's discuss this. See, going concern concept like that, like this, that it is assumed that business shall continue for indefinite period. Okay, we we start a business so that it can go for years. It can run for years. No one starts a business like he's starting a business. A person is starting a business thinking like that I will shut my business in next year or in next 6 months. No person will start a business with this mentality. Every person wants his or her business to grow more and more and to run for many years. So that is what going concern concept is about. Whenever we are spending our money on our assets, we have to be careful, like rent, repairs, and all. Coming to the point, accounting period concept. See, We should maintain the financial statement to keep analyzing them at regular intervals. At regular intervals, like uh, at at the end of every financial year. At the end of every financial year, in on 31st March of each year, each and every year, we prepare final accounts. We prepare final accounts. Every business perform this activity. So preparation of final accounts on regular basis or at on in every year is known as a continuation period or accounting period concept, that we should be continue analyzing our transaction or our accounts. Matching concept. Expenses incurred in an accounting year should be matched with the revenue earned during that year. Whatever expenses you are making in a particular year should should be matched with the revenues earned during the year. It's not like you are spending more and more in a year and you are getting nothing out of it. It should not be like that. So we should have a matching concept. This is what matching concept is all about. Conservatism concept, as the name says, always make provision for losses. Like always think about the losses. I'm not being negative here. It is just like always be conservative for your losses. Like uh, keep your keep your firm, your goods. Okay, keep your firm, your goods, your machinery insured, so that any problem occur in them, you can get the money. Keep making provision for bad debts and all. Suppose you have debtors of 70,000 bucks, but out of those only 30,000 you get back. You will lose 40,000. So for that case, or in this situation, you have to be prepared before that or prior that situation happened to you. You have to make provisions for your losses, like provision for doubtful debts, provision for discounts you will be making it to debtors. So this being conservative is a good thing. Consistency concept. Consistency concept. Whichever method of accountancy you opt for your business, just keep that rule, just keep that rule for a longer period of time. It's not like that keep changing your accounting rules again, too quick in your company, again and again, more frequently in your company. Just stay on your rules you have adopted for your business. Just stay there. Use them. Don't keep on changing the rules every year. Full disclosure concept. Full disclosure concept. The financial statement are basic means of communicating financial information to all interested parties. Like you have to disclose your financial accounts to inside or outside users. This is what this concept is telling you about. And materiality concept, it is somehow similar to full disclosure concept, but this doesn't say that you have to be relevant, complete and full. You have to give relevant, complete and full information about your business to someone. But this says that you should provide relevant, complete and full information to your investors, to your creditors, to public, to government. So these were the concepts on which an accountancy ran. System of bookkeeping, double entry system and single entry system. So in many businesses, or or if I say every business follow double entry system, because it have dual effect. It nullifies the effect of other entry. Okay, every business, almost every business in this world uses double entry system, and single entry system is used by few businessmen, or very or the if you have a small business firm, then you can use single entry system. It is not like that you are recording only one entry, you are recording complete entry, but you don't have the two aspect of transaction in this. Sometimes you omit, sometimes you do mistakes in recording the transactions or in transferring the transactions. So it is single entry system. It is not more reliable, it is not understandable, it is not complete, it is not a systematic way to record a transaction, or to systematic way to create accounts. So this system is followed by small business firm, but dual entry system is followed by every business, every big business or big organization or company, because it have two aspects. First is receiving and second is giving, which we discussed earlier. This unit is also complete. Should I start next unit, or is this enough for today? I guess that much of information is enough for today.
Yes, I think we still need to go through so that we can actually understand better. You've been a bit fast today,
Yeah,
then I think
but
personally I've
but
missed
you
out on some
have,
points.
sorry, you were saying something.
Yes, I was saying, like the information that you've provided us with today, I feel it's enough for today because we've personally for me, I've missed out on some points, and I feel we'll understand better if we study it with the notes.
Okay, okay. And okay, so the next unit we will do in next class. But before that, let me give you a homework for this time. Please read all these three units and the next unit as well. Please read it. Okay, for better understanding. We will discuss the next unit as well. Fourth unit we will discuss here. But if you read it, then it will make your points very clear. It will be easy to understand. And if it is a practical subject, you have to practice a lot. It is a practical subject, so you have to work a little bit on these things. If you learn the rules and all, then the other blocks will be easy for you guys. Okay, if you learn rules, entry, and if you understand the basic of accounting, then performing the accounting will be very easy for you guys. And in next class, we will learn how to make journals and ledgers and trial balance. Okay, the practical questions we do. Now, if you have any question or you want to say something, you can by writing. And before that, please turn on your camera so that I can take attendance. All at a time. Wait. Please turn on your camera. All at a time. Okay, done. Now, if you have any question, you can ask. Any questions?
Ma, please,
I
I
guess.
need little explanation on double entry. I am confused. Hello, ma.
Hello, who is it? Okay, I guess now we conclude the class. I don't think so. You have any questions regarding the subject, but you need to read these units for better understanding. Okay, this is
Ma,
your homework.
can I ask question?
Yeah,
Ma, are you taking us two class for communication, business communication and
yeah, yeah. Actually, I
financial
have
accounting?
three class. Abdul, I have three classes. First one is business communication, and this one BCOC 131, which is financial accounting, and one is management, business management and organization. I have three
Okay,
classes.
three class.
Yeah,
Okay, hold on, ma. Ma, I need more explanation about double entry, please.
nominal account.
Double entry.
What are you saying? Not understanding.
Double entry.
Double entry. See,
Yeah,
it is
I'm not
simply
sure.
if I say in simple words, it is giving and taking. Okay, one thing you take,
Okay,
other thing you give. You
okay,
take goods. You take goods from some person, then you have to pay them in form of cash. That is
okay,
what double
okay,
entry is. Double entry tells you that you should pay. You should pay to receive the goods, and you have to record both the entries. Like when it comes to cash account, you will enter this entry of purchasing goods in cash account. But when it comes to goods account, then you have to mention this entry in goods account too. It will give you double effect, like you have received something and you have gave something.
okay.
That is what double entry is.
Thank you, ma. Understood well. Thank you, ma.
Abdul Rahman has raised a hand. Yes, Abdul Rahman, asking something. I guess everything is clear
Yeah, ma.
now. Okay, let's conclude the class. Bye. We
Bye,
will
ma.
meet on Thursday for business communication. Okay, bye.
Okay, ma.
Please
Alright,
take
ma.
attendance of the class. All right.
Ma, I have question about
Yes.
the side you give us last lecture. From the side we are going to download our note.
Download the books. You want to know about the website at all?
Okay. So if I have e-content, can I use it?
Sorry.
I say if I have e-content, I have e-content
Okay.
that containing all the subject,
You
all
have
the courses. Yeah.
e-content of the courses. You can read from there as well. What I'm
Okay.
asking is just read from wherever it is. If you have syllabus, then read it. Read it
Okay.
from Google. Either read it from your e-content, and either download these books or read it from here. What I'm saying is just
Okay.
read it.
Okay, ma. Thank you,
Okay.
ma. I'm wishing you the best.
Thank you. Thank you.
Oh, thank you, ma. Bye.